You sign the lease. Your landlord shakes your hand and says the same thing every landlord says. Renting is just throwing money away. You nod. You believe it. Almost everyone believes it. But that sentence isn't math. It's marketing. And for the next 30 years, it's going to shape one of the biggest financial decisions of your life. Here's what actually happens when you buy a home. You put down 20%. Call it $60,000 on a $300,000 house. You get a mortgage. For the first 10 years, most of your monthly payment doesn't touch the loan itself. It pays interest. That's how amortization works. The bank designed it that way, front-loading interest so they get paid first, and you build equity last. You also pay property tax, insurance, and maintenance, which economists estimate at 1 to 2% of the home's value every single year. Robert Shiller, the Yale economist who won the Nobel Prize for his work on asset bubbles, spent decades tracking U.S. home prices going back to 1890. His findings surprised almost everyone. Adjusted for inflation, home prices barely grew for most of the 20th century. The dramatic gains you hear about mostly happened after 1997, in a specific window of cheap credit and speculation. The same window that produced the 2008 financial crisis, when millions of homeowners discovered their safe investment could lose 40% of its value in 18 months. There's a real counter-argument, and it deserves airtime. Rent isn't fixed. It climbs every year, often faster than wages. A fixed-rate mortgage, by contrast, locks your biggest housing cost in place for 3 decades, while everything around it gets more expensive. Economists who study urban housing markets, including Harvard's Edward Glaser, have shown that in cities with restricted housing supply, rent growth can outpace inflation for years at a time. That's a genuine advantage for owners. It's also the reason this comparison only works if you actually track it honestly, instead of picking whichever fact supports the choice you already made. So why does everyone still say renting is throwing money away? Because nobody shows you the other side of the math. Here's the version they skip. You rent the same house instead. Your rent is, say, $1,400 a month. The buyer's total monthly cost, mortgage, tax, insurance, maintenance, is closer to $2,000. That $600 gap doesn't disappear. If you invest it, every month for 30 years, in a low-cost index fund, something changes. This is where John Bogle's work matters. Bogle spent his career proving that most people don't need to pick stocks or time markets. They just need decades of compounding in a diversified fund with low fees. History's average annual return for the S&P 500, before inflation, sits around 10%. Even at a conservative 7% after inflation, $600 a month for 30 years grows to over $700,000. Not the $60,000 down payment. The monthly gap alone. Let's walk through what actually happens to both people over 3 decades. Year 1. The buyer has $60,000 of equity, tied up, illiquid, unavailable if the car breaks down or the job disappears. The renter has $60,000 sitting in an index fund, already compounding, already working. Year 5. The buyer has paid down a little principal, maybe $40,000 of real equity gained. The renter's initial $60,000 has grown past $80,000, and the monthly $600 contributions have added another $40,000 on top. The gap is already closing in the renter's favor, and almost nobody notices because a house is something you can see and touch, and a brokerage account is just a number on a screen. Year 15. The mortgage is finally past the halfway point, where more of each payment goes to principal. Then interest. The buyer's equity, boosted by super modest depreciation, might sit around $200,000. The renter's portfolio, compounding quietly the entire time, has crossed $300,000. Meanwhile, the renter's landlord has raised rent 5 separate times. The gap they're investing each month isn't $600 anymore. It's shrinking because rent grew and the mortgage payment didn't. This is the part the simple version of this story always leaves out. Year 20. The buyer's home is fully theirs in another decade, and the psychological weight of that is real. No landlord, no notice to vacate, no rent increase letter in the mail. The renter has adjusted. Some of that shrinking monthly gap gets redirected from investing into rent itself, which slows the compounding slightly. But 3 decades is still enough runway for the math to keep tilting in the renter's favor, as long as they never stop contributing something. Year 30. The mortgage is paid off. The buyer owns a house worth, after modest long-run appreciation, somewhere around $500,000. Real wealth, but locked inside 4 walls you can't spend, without selling or borrowing against. The renter's portfolio, still holding the original contributions, plus 3 decades of reinvested growth, often exceeds $700,000, sitting in an account that can be spent, moved, or passed on with a few clicks. Here's the counterintuitive twist. Buying the house isn't the wrong decision. Failing to invest the difference is. The house was never the enemy of your wealth. Your own behavior was. Thomas Piketty, the French economist behind Capital in the 21st Century, studied exactly this pattern across 200 years of data. Wealth doesn't concentrate because people own homes. It concentrates because some people consistently redirect surplus income into appreciating assets decade after decade, while others let that surplus quietly evaporate into lifestyle spending the moment it appears. A home can be one of those appreciating assets, but so can a retirement account. So can an index fund. The asset matters far less than the discipline behind it. There's also a risk the house hides that the index fund doesn't. Harry Markowitz, the economist who won a Nobel Prize for modern portfolio theory, proved mathematically that spreading money across many assets reduces risk without necessarily reducing return. A single house is the opposite of that. It's one asset in one neighborhood tied to one local job market, one school district's reputation, one city's economic fortunes. If that local economy struggles, a factory closes, a major employer relocates, the house can lose value with nowhere to hide, and you can't sell 10% of it to rebalance. An index fund holds a slice of thousands of companies across every industry at once. Concentration feels safe because you can see the walls around you. Statistically, it rarely is. This is why the renting is throwing money away line survives. It's emotionally satisfying and mathematically incomplete. It assumes the renter takes that $600 gap and spends it on dinners and upgrades. For most people, that assumption is correct, which is exactly the problem, and exactly why the phrase keeps getting repeated at dinner parties by people who've never run the numbers. So which one should you actually choose? Wrong question. The real question is what you do with the gap, whichever side of it you're on. If you buy, you're forcing yourself into a disciplined, automatic form of saving. The mortgage payment doesn't care how you feel that month. If you rent, you inherit flexibility and a lower monthly cost, but you also inherit full responsibility for investing what you save, with no bank forcing your hand. There is one number worth actually checking before you decide anything. The price-to-rent ratio, the price of a home, divided by what a year of renting it would cost. Below 15, buying usually wins over time. Above 20, renting and investing the difference usually wins because you're paying too high a premium for the emotional certainty of ownership. Most major cities right now sit well above 20. That single number does more honest work than any conversations with a landlord, a realtor, or a well-meaning relative who bought their house in 1985 and thinks the math still works the same way. Look at your own life right now. Maybe you're paying rent and telling yourself you'll start investing once things settle down. Maybe you're saving for a down payment and assuming the house alone will make you wealthy. Both stories have the same blind spot. Neither one is really about renting or buying. Both are about whether the gap between what you earn and what you spend ever gets pointed somewhere that compounds. 30 years from now, the property records will show whether you rented or owned. They won't show whether you built wealth. Only one number will tell you that. The one sitting quietly in an account you either fed every month or forgot about entirely. Nobody at the dinner table asks about that number. Everyone asks whether you own or rent, as if the deed itself was ever the thing generating wealth. It never was. The deed is just paperwork. The number in the account is the actual scoreboard. And it's been running the whole time. Whether or not you were paying attention to it, you signed the lease, or you signed the mortgage. Either paper was never the real decision. The real decision was what happened to the money you didn't spend.